the following icebreaker introduction, which is name your favorite smart contract and why. And I'll go first, so that, or in fact, maybe it doesn't have to be a particular smart contract, but it can be a fact about that smart contract. So there's a paper I saw that came out this week that did a sort of analysis of like how much Solidity uses inline assembly, which obviously is the source of many security vulnerabilities. And the number one, so 23% of Solidity bytecode, it comes from inline assembly, according to this paper. And the number one culprit is the Gnosis proxy contract for Gnosis Safe. So I think that deserves a special mention.
That's a good shout out. Hi everyone, I'm Noah from Uniswap. I have to be a shill here. My favorite contract is the Uniswap V3 factory because I wrote it and there's been no bugs so far. So let's go. That makes me very happy. Yeah, I'm one of the DeFi sort of boomers that Tarun mentioned. So I've been around DeFi for a while. Happy to talk about the past, but excited for the future as well. So I'll hand it off to the next.
I was also going to say Uniswap V3, but okay, so hi everyone. I'm Mathieu. I'm co-founder at Llama.finance. We were the first to come out with a stablecoin backed by delta neutral derivatives position. There's going to be some alpha leakage after, but we're coming out with a V2 next week, so I'll maybe show that at the end or something. Favorite smart contract? Oh man, there's quite a few, but yeah, I was gonna say Uniswap V3, but probably like the Aave one. I think like the flash loan stuff is fascinating. So. Yeah.
Cool. Hey everyone, I'm Jonas, one of the co-founders of Empiric Network. We're ZK Oracle focused on ZK rollups and layer 2s. My background is actually in data ML. Makes sense with the Oracle, there's a lot of that there. And my favorite contract, I'm going to pick something a little meta, is account abstraction on ZK rollups. Ethereum's been working on it for a while. ZK rollups have it. So there's an account that you can use to sign transactions that uses not an ECDSA key or whatever, it uses the secure enclave on an iPhone. So all of a sudden, I think that's a huge improvement in UX and something I'm really, really excited to see more of.
Hey everyone, I'm Maher. I'm one of the researchers at Jump Crypto. I have traditionally an economics background, so I'm sort of an economist on the team. I like to think about tokenomics and economic design and mechanism design. I would say certainly, probably maybe one of my favorite smart contracts is the PID aggregation method. That's something that's super exciting as well, but also a big fan of Uniswap V3. So yeah.
Cool. So I think we've touched a little bit on some of these things. Actually, I'll give a shout out to the original creator of the Flash loan, which is Max Wolf, Marble Finance, which they were the first Flash loan, but unfortunately they didn't make it and got bought by Compound, which did not add a Flash loan. Alas. I would love to hear what you think that we have in DeFi today. But which things are things that don't exist in normal finance, and which ones are the ones that people take advantage of and don't take advantage of? Obviously, flash loans are the thing that really stands out as particularly non-normal financing. But yeah, I would love to kind of hear like which things you think are kind of the unique differentiators right now in September 2022.
I guess I'll start by saying, specifically, I think that composability is, and this is also my biggest, value prop for DeFi, which is that composability is when you start interacting with value, money, rather than data, all of a sudden having protocol and having certainty on what your value is doing, it becomes so much more table stakes. And so specifically, I think that being able to build on other financial protocols and having a verifiable way to know that you're not going to get rugged is something that I haven't really seen in the traditional finance world that is starting to become bigger and bigger in DeFi. Specifically, yeah, like for example, on Uniswap or like derivative protocols like perpetual protocol.
I would just second that. I think I'm originally from Germany, so in Europe, I mean in the US you have Plaid and you have a few of these, but I think the TradFi equivalent is open banking, and in Europe there's PSD2 is the name of the regulation that mandates that banks open up APIs that lets people have read and write access to their bank accounts, and that's spawned a huge multiple $billion of fintech industry of what you can do with that. And it's a slow process with regulations. Turns out the banks put up really shitty APIs that then you need other people to come in and build aggregators on top of. With DeFi, just to second your point, we have this all out of the box. We have it irrevocably so. So I think that openness of, if I want to build a protocol, here are these Lego blocks that just snap together. That's really, really powerful, and we don't have that in TradFi.
Yeah, I don't have anything sort of specific, but at a very high level, and this is one of the sort of main benefits that people have been pitching forever about DeFi, but it's the transparency. I read this hilarious Matt Levine thing a couple weeks ago about this guy who had some crazy, like binary option on, some like commodities market, and he was like a couple percentage points off, triggering the option for a big payout, and he like just manipulated the spot market to try to push the price, past his payoff point. And I think that they uncovered this through like, reading his messages and, just sort of looking at anomalous market behavior. And I just think it's great that in DeFi that sort of, it can happen, of course, right? There's ways to manipulate and all that, but there's no way to sort of hide, and the sort of global state is accessible. There's no specific exchanges or venues or types of markets that are more or less transparent. You don't have to worry about trying to like read bankers' chat logs, right, on like Bloomberg Terminal. You can sort of trust that that the entire state of like the leverage and options payouts and things like that are fully sort of transparent to the world, and that's both good and bad. But I think it's very I think it's healthy, hopefully, in the long run. So I'll say that.
Yeah, I think I'll second that as well. Transparency in these markets. So I used to work at the Federal Reserve Board before joining Jump, and I was there during COVID, and that was a massive, difficulty for the financial markets. People don't know that these like regulatory institutions often fly blind when it comes to understanding and analyzing these financial markets. The data is very, very partial, so you have no idea where solvency risk is and where the risk is most concentrated. And within DeFi, right, everything is on chain, everything is accessible, and as a consequence, you can actually better understand where risk is and understand sort of market schematics. So I think that's something that's quite novel in an important paradigm as well.
Cool. Actually, let's talk about a little bit about MEV, which is maximal extractable value, and maybe not minor, unfortunately, anymore. MEV, for those that don't know, is sort of the idea that you can bribe the validator. Maybe bribe is too connotative a word. You can pay the validator of this particular block some sort of excess fee to guarantee some extra atomicity to your transaction. So I want this particular sequence of transactions to be executed in this order atomically. That means that you can do things like front running, back running oracles, kind of taking advantage of different things in the sort of state space. So one thing is like, there's this common narrative, I guess, in the theory that MEV is bad. But there's also this just clawingly true fact that almost all of DeFi relies on MEV. Like, the arbitrage volume is juiced by the fact that there's tons of MEV. Uniswap really grew, especially the maker DAI pool, because of all of the backgrounding. I mean, you can just go see it on chain. So I guess the real question is, how much of MEV is parasitic to DeFi and how much is necessary, and then sort of where do you see that equilibrium going? And obviously you have the longest track record of looking at this, so I'll let you start.
Yes. That's a great question. I think it's going to be one of the most exciting things to sort of watch develop over the next sort of 6 to 12 months as the merge sort of crystallizes. I think my opinion on MEV, so we can get into the specifics, but one thing I want to just call out is that I think Uniswap in particular, a protocol that I in part designed, at least the implementation of, right, which is relevant here, does leak a lot of MEV, right? Like there is no, the sort of game theoretic properties of the system does rely on arbitrage over profits to, maintain sort of price, comparable pricing to off-chain venues, but that value is explicitly sort of put up for grabs to sort of whoever can get it, right? And that just creates this sort of honeypot for people to fight over in the mempool or in flashbots auctions, what have you. So I think one thing that I'm excited about in terms of sort of a future research direction is in-housing or internalizing the MEV that's leaked by a protocol. And obviously, this isn't super novel. People have been talking about this for a couple months or probably longer now. There's been some ETH research posts, things like that. But I think running auctions for exclusive rights to be the first transaction in a block in Uniswap would be a potential way to capture the MEV that's leaked currently by the mechanism design of Uniswap and then redistribute that in a more sort of targeted or specific way. Right, and of course you might need to sort of throw a bone to arbitrageurs because they are providing a service. They're running off-chain infrastructure. They're keeping prices in parity, but they might not deserve the entire sort of bounty for every pool, for every swap, et cetera. And so I think we're going to see a similar, hopefully, development of the profit is going to be shared between various parties, builders, searchers, validators. It's going to be a constant give and take, and I think that we're going to see protocols sort of get into that game, right, and be a component of MEV, and they're going to start taking their share.
So I'm going to chill myself here, which is I just wrote a paper on this.
Yes.
But I would say one interesting thing is Cosmos is the place where all of the actually interesting experiments on this are happening, because each app chain controls its own consensus, and they all are things like Penumbra are basically building in, given a set of order flow, optimally route it and commit it as a sort of blinded batch transaction. So I think the interesting thing is going to be seeing which experiments in Cosmos work, because MEV is just so much more tangible there, and then transferring that into other chains, which will be, that's sort of what I think the next year will look like. Anyway, sorry for front running other panels.
Sure, I can go. I think so. Would second the last point. I think on protocols capturing some of that MEV. I think one other interesting thing that we're seeing on the Oracle side, there's this term Oracle extractable value, whatever. In the end, it's all about ordering of transactions. Is with sort of the immediate phase post merge, randomness being determined once per epoch. You have this interesting thing where I can know ahead of time that I'm going to get 2 blocks in a row. And so I think that changes some of the calculus around, if I take certain, state at the top of the block, or if I send one transaction in one block and one in the next, what guarantees can I get around, who's extracting value there? So I think that we'll see some interesting things around TWAPs and what people do there, whether, that becomes, how that plays out will be interesting to see.
Yeah, just to second that. So we have a research team that's looking at sort of Oracle-based AMMs, and I think it's similar to that sort of schematic as well, whereby you have, PIF providing the sort of fair value, and that, bot or arbitrageur will then sort of be able to, arb the actual AMM and then provide and redistribute the profits amongst the LPs. And so this is, I think, in line and quite similar to some of the things that we've discussed. So I think it'll be out in the coming weeks. We call it the PIF Defender.
So,
I was just gonna also show a protocol that I kind of like, CalSwap, which does batch options. I know that we said that MEV isn't necessarily a bad thing, but I feel relatively speaking, they found a pretty cool workaround. I know they're a competitor to Uniswap, so it might be.
Yeah, I think this the vilification of MEV was very useful for shining a light on it, but it's not mathematically a correct view, right? These systems there's some just excess cost that has to be paid to keep these systems stable. The question is who gets that cost, how it gets distributed, and I think unfortunately people on Twitter don't like the nuance of this idea, that sometimes MEV can actually be optimal for these systems. It helps improve routing quality.
Yeah, it's kind of the same thing as impermanence loss, where people just
I really hope that word dies in the next year or two, but unfortunately I think the meme has stuck. All right, this one is a little more contentious based on our panelists here, which is, will oracles be necessary in 10 years, 5 years, 25 years? Or do you think we will get to an oracle-free world? Given that we have two representatives of oracles here, the king of we don't need oracles, and you in the middle.
pretty much.
Yeah, that's a great question. I don't know. I mean, Uniswap is a great example of a mechanism that works without the need for an oracle, because it incentivizes sort of third-party actors to work on your behalf, and that's exactly Tarun's point with MEV being a useful sort of service that that pays for things. I think naively, you definitely need, you can sort of replicate a lot of TradFi products with, just an oracle, right? You can structure options payouts, things like that, with access to a sort of trusted price feed. Uniswap exposes its, mid-price in this oracle sort of accumulator fashion, but it's, maybe manipulable. It's worse post-proof stake, certainly. I don't know. I would love for, just to shout out Guillaume Lambert on Twitter. He has this really interesting, maybe not fully public, so I don't want to say too much, but he has this very interesting design for a sort of options protocol that's based on Uniswap V3 liquidity positions, and not to shill it all this Uniswap, but it's interesting to think about sort of replicating payoff structures and things like Tarun. You had a paper on this as well, from last year. Via these mechanisms that don't necessarily need an oracle, and again rely on market forces to arbitrage and replicate payoffs, right, of something that in TradFi would rely on an oracle. So I'm no expert beyond that, but I think that's what's so interesting about DeFi is that you can think about, you have this really broad open playing field, and sure there's constraints. It's expensive, it's hard to get off-chain data, et cetera, but the benefit is you can get it's a true marketplace of ideas in some sense. So we'll see. We'll see a lot of creative things and creative people, and that's exciting. So
from the oracle side,
yeah, I mean, I expect that as Pith and other oracles expand into non-crypto, non-equity assets, that they will still continue to prove their value within this space, and that's something that I think is a new trend that we're certainly moving towards. Can't probably discuss or disclose too much, but I think a lot of exciting new data will be provided. So that's certainly one thing. I think the other is that oracles will continue to kind of prove their value in the non-sort of AMM DEX space, right? So with respect to money market protocols, right, there all constantly needs to be an oracle to sort of assess and understand the collateralization ratios. And so that's sort of a key and critical feature. But we're certainly bullish on the sort of AMM-based or oracle-based AMM, and that's something that I think is a core and critical function that might be part of DeFi in the future.
I second that, but I would add two more things. I think one thing is as long as volume on centralized exchanges is as much higher as on DEXs as it is today, that's just higher quality data, right? And so the volume and the liquidity is where you're going to get the most accurate prices. A thing that we're actually working on is combining the best of both worlds, right? So taking on-chain data from a bunch of different on-chain sources and combining it with off-chain sources, because the way we see it, there's not sort of some fundamental, we only like one kind of data and not the other. It's about getting the best and most robust price data or market data more broadly, and so use both. And then the other thing I would say is that for sort of going beyond, right, similar to what you were talking about, going beyond the crypto asset data, I think we'll see a lot of interesting things there, both in terms of other markets, but then also in terms of additional types of data, right? Whether it's weather data for parametric insurance, sports data for sports betting, fantasy sports, all these types of things. I think you can have the on-chain market like a Uniswap to discover price, or you can use price to create the market. There's sort of a back and forth there, and I think we'll continue to see both.
Cool. It's funny because I really am in the middle. I have like very conflicting thoughts on this. And on one side, I do think that like pretty much every single DeFi use case you can think about has like an Oracle-less implementation. And in fact, like usually it's like a superior implementation, but at the same time, arguably, the thing that has the best product market fit in crypto right now is stablecoins. Stablecoins, as you know, is real world assets. And until the price discovery for all real world assets is done on chain, if we want to have any of those assets on chain, then we are going to need oracles. And I do not see all of the price discovery for all assets being done on chain like anytime soon.
Yeah, I mean, I think these bring up some good points in the sense of like, you know, in the theoretical limit, you sort of can have these perfect replications and not really need, you can only rely on arbitrage, right? But in practice, transaction fees, relative liquidity differences, stuff like that are always going to kind of dominate how well you can actually replicate the exposure you want. So let's move to some exposures that don't exist in normal finance. You know, earlier we talked about what you can do in September 2022. But if we look to the future of what new technologies are coming out in crypto over the next 12 months, you know, obviously the dominant thing is a lot of zero-knowledge proof related stuff, both from the hardware acceleration side, as well as from the sort of like, we've kind of crystallized a couple zero-knowledge proof standards that I think are, you know, seems like Plonky is the way that the world is going to be moving, and we're going to be having a ton of ZK rollups in that world. So where and how do you see DeFi adapting and taking advantage of some of these new technologies? You know, I think like there's a ton of examples, but you know, the problem with the ZK stuff in general is there's very few applications that have been built that take advantage of it natively right now. And a lot of that is just reasoning about whether it helps or not. And you know, I think Jonas probably has the.
Yeah, I can start.
You should start.
I spend a lot of my day thinking about this. It's a great question. So I'll give two answers for two different aspects of ZK. The first is on the scalability side, right? So ZK gives us exponential compression of compute, and that's why we're building ZK rollups, because they have that component. I think what we're already seeing with DeFi, what at Empiric we spend a lot of our time thinking through is, you know, now that we have this you know, lower gas, higher TPS, how does that change DeFi, right? AMMs like Uniswap, one of the things that they did amazingly well was they worked within the constraints of the Ethereum layer 1. And now when we shed those constraints, or more realistically, when those constraints change, that has huge implications for making DeFi more capital efficient, for changing the types of structures of how we build markets. So I think that's sort of the first thing that we'll see, whether that's, you know, more on-chain order books, or whether that's sort of dynamic adjusting of TVL, of the hyperparameters of you know, lending borrowing protocols, of stablecoins. I think all of those things will be really exciting. The second thing I think we'll see with ZK Tech, and this is I think still further out than the scaling part, is some differential privacy. And so you'll start, you know, I think that there's some ZK rollups or even ZK layer 1s that are starting to do work on this that's quite interesting. So that I think both on the network level of privacy of certain types of storage, as well as on the individual level, privacy of certain types of credentials or transfers is quite exciting, and something that I think we haven't seen before without that tech.
Yeah, I second that on the fact that I think a lot of people maybe last year were like, oh, like we'll just throw DeFi in the ZK thing, and like now it's private, and like clearly that was not true, right? There's always this public-private information split. I think the most painful paper I've written in the last 2 years was proving some differential privacy things. So like I'm kind of hoping some of those get used for selfish reasons, but I think that is definitely the ultimate application right now. But are there, when you talk about capital efficiency, like how do you imagine, say, a ZK Oracle improving capital efficiency versus, say, a non-ZK Oracle?
Yeah, so I think what you get here is, right, most of what oracles do today is simple price feeds. I think that's great, that secures a ton of value, that's necessary, obviously in addition to decentralized on-chain data sources. But I think what we're seeing a push towards is more advanced types of data on-chain, right? Things like yield curves, volatility feeds, things that before we either computed off-chain in a black box. And it turns out these things are much, much more complex and so much harder to trust than a price feed. Like, if you tell me the price of Ethereum is $10, I'm gonna be like, no. But if you tell me the volatility surface looks like this, it's much harder for me to sanity check that. So moving that on-chain and having trustless computation there, I think is much, much more important. Right, and then once you have that, sort of that new primitive, that new way of looking at markets, which by the way in TradFi we've been doing for decades, then you can say, well, instead of setting, TLV, LTV to be 30% over collateralized or something, let me vary that based off of which assets I'm talking about. Let me vary that based off of sort of the state of markets overall, dynamically over time. And the result is a protocol that's much, much more capital efficient.
Anyone else on ZK stuff?
Yeah, I mean, so BIF has a ZK roadmap as well as Oracle. So, I mean, we certainly believe that ZK enables the optimal sort of trustless environment, and that's something that I think we're incredibly excited about. We've been developing a really robust sort of in-house ZK applied initiative, and we're also contending for the ZK prize as well. So it's something that the broader firm is incredibly bullish on, and so that's something that we're excited about.
I guess I'll say like one last thing. Actually, it's mostly just a little bit more on like what you said on capital efficiency and then privacy. So starting with capital efficiency, I think like the big thing here is like, the faster the TPS, essentially, the better you can essentially calibrate for like risk engine, right? Because like essentially like the less like price jump or like the less essentially your price can move in between blocks, which means that you can have you are like more informed as you do liquidations, and the faster and like the more accurately you can do liquidations, the more leverage you can offer traders, and the more leverage you can offer traders, the more capital efficiency you have. And the other thing is, I'm a big fan of Aztec Network. John Wu is here somewhere. He's like your head of growth. I think that there is an entire design space that hasn't been explored yet with privacy preserving DeFi. Like a lot of stuff actually that we haven't seen, that we have seen, like even in traditional finance, which is like, as we've covered before, not very transparent, like dark pools and stuff like that. That like I think that we will eventually see in DeFi in like some form or another. So
cool. I think in this vein, how DeFi was born out of effectively the maker died pool in Uniswap in 2018. It was like the only way to get MKR unless you did a private sale with the Maker Foundation. And so effectively there's no way to get Maker. The system wasn't stable. It had this like intrinsic need for a DEX. Oasis sucked. Sorry, any Maker fans. And also people didn't want to really KYC to get done. Fast forward to 2022, and I have to like sit through 5 million people talking about KYC DeFi, and I'm like, what the fuck is the point of DeFi if we have to have so much KYC? So I guess I'm curious to get everyone's opinions on like the future of that. Is that the only way to actually get more capital into the system, or do you think we'll find a native way, the same way that like Maker created DeFi single-handedly, effectively?
Remains to be seen. I think. I think what's important to take out of that preface is like, DeFi was born out of a specific sort of need and in a very specific sort of market condition. I would say SpankChain is another great example of early Uniswap users, right? Like there was this sort of gray industry of adult performers that had trouble getting paid. Arguably they haven't had a very successful sort of product that actually solves a lot of real adult performers' needs.
Tether worked great.
Right. Tether works great, maybe. But anyway, I think there's very sort of cypherpunk roots to a lot of DeFi, and I think ideologically, the people that I'm all working on this space are those types of people, right? Who are not served by the traditional financial ecosystem, and while I do think it's great to sort of tinker with mechanisms that improve on various TradFi primitives or offer sort of more broad-based access to those primitives. Those are great, but I think that ultimately crypto has at its foundation a sort of a fairly radical value proposition, which is that the sort of disenfranchised of the world of the sort of people that didn't have access to even basic financial instruments, let alone complex like leverage and options, protocols, things like that. Those are the people that we are sort of should be in crypto to help, right? So that's why I like the space, and so yeah, I'm very not bullish on KYC, and sort of institutional entrants are fine, but to the extent that they bring greater liquidity, but I'm not sort of putting all my chips on them, so to speak. So yeah, I think that there's inevitably going to be we're already seeing conflict, right, between the sort of regulatory bodies in the United States and various sort of DeFi protocols. So yeah, I think there's going to be conflict going forward. It's not going to be easy for institutions to say put their assets on Ethereum because it's it's very resistant to censorship and KYC doesn't come naturally, I would say, to protocols. So I think yeah, there's going to be a tension going forward for sure, and I think it's just something to be aware of, especially for those of you who are maybe newer to the space and don't have this sort of interesting view on the history there. So
first of all, love the ideological view of what DeFi should be. I don't think that KYC would kill DeFi because I still maintain that realistically there are two main value propositions that are going to make it the main financial system, and unfortunately, that's kind of where I disagree with you on what's actually going to happen. Which I think basically there are two things that are going to make DeFi main financial system, which is number one, the fact that in the current traditional finance system, you have so many different intermediaries that have popped up that the fees are just kind of outrageous on a bunch of different things, and I think that fee reduction is going to be a massive boost for DeFi, and the other one is composability. But honestly, fee reduction and the removal of intermediaries is going to be the biggest one. It's kind of a hot take, but not very cyberpunk.
I suspect you're going to have some more people agree with you shortly.
Well, I disagree. So I think DeFi should not cater to institutions and regulatory bodies. As a matter of fact, it should be the inverse. Institutions should change to DeFi sort of core values. And I think that's I think I really echo a lot of what Noah is saying. So one of the core sort of key value propositions in the current state of DeFi is allowing people in emerging markets with high inflation, local currencies to save in stronger currencies, right? Let's say the example here being the dollar, and that's I think one of the key and core values that might go away with KYC. We don't have the stats on it because exchanges are the ones that are the main sort of harbors of these people who are essentially using Binance and FTX as quasi-savings accounts, and they're just swapping their fiat for stables via the P2P markets that they have. These exchanges will never sort of publicize their data, and rightly so. It would certainly attract regulatory scrutiny, but that's I think one of the key and core values that kind of might go away with more rigorous standards when it comes to KYC in initiatives. Yeah.
To make this interesting, I'm more back on the pro KYC side. I think sort of where I come from is, I think money laundering is a bad thing. I don't think tornado cash should be banned. So I'm somewhere in between. There's like nuance. Turns out the world is complicated. But I think elements of KYC and identifying counterparties, just realistically speaking, are going to be a part of it if we want DeFi to go mainstream and to serve as the rails as the back end that finance runs on, whether TradFi and DeFi will sort of merge and it's just finance, and the rails are what runs either on blockchains or elsewhere. And so I think it's both going to be necessary, and I think it's actually a good for the world to separate what I would call sort of the huge value add parts of DeFi from some of the more problematic ones.
So yeah, I guess to this point, right, we have basically seen a very abysmal uptake of derivatives in DeFi, and part of the reason for that to some extent is that the quote institutions unquote of crypto are not exactly like buying, or not exactly like big hedgers, as we learned in up-only season. But also that they're not really like long-term holders of derivatives, right? In the normal financial market, if I'm say, BlackRock, I offer some ETF, I tell you that it has to be a certain composition. I will also usually hedge in the futures market. I will just go buy gas futures because the airline stocks are anti-correlated to it, and I need to be. It saves me rebalancing costs, and so my net portfolio looks like what the composition is supposed to be. Those people are perpetual long-term buyers of these complex products. So post Uniswap, Compound, Aave being successful, we saw this, of course, the DeFi summer boom of everyone and their mom opening up, derivatives, textbook and being oh, I'm just gonna put X on page 50 on the blockchain. Obviously, all of those have zero uptake, maybe negative uptake, because they had to pay out incentives that, depleted their treasury. So I'm kind of curious, how do you think about how institutions with a capital I, not a lowercase I, actually get into DeFi and actually make these derivative markets liquid? Because we're just never going to actually have those things be liquid if there's not someone who wants to actually buy futures and hold that exposure for a long time. And I think some of you have said, oh, it's real world assets. Some of you said it's other things. Where do you view that? How do we grow that pie? Because otherwise, the spot market is always going to be kind of smaller than the derivatives market. That's just the way the universe works.
I kind of have a hot take on this. I don't think that perpetual futures are good for institutions because of the way that funding rates work. They are just incredibly hard to price for any TradFi investor. And when people can't price futures, they can't trade them correctly. And so I think that we're going to have to invent a new kind of instrument that also has a lot of value, that essentially just makes it easier for institutions to come in. So yeah, basically.
You think new instrument. All right. And next proposed solution.
I don't know that I have sort of a particularly hot take on this. I think one of the things that we see is sort of with these institutions both sort of having the comfort. I think just last week we saw that turns out key rotation is difficult, and people get that really wrong. And so I think some of the sort of infrastructure being built out there for just the management of capital and turning things from sort of a complete Wild West into things where it's they're established procedures and things that even in DevOps we've figured out quite a while ago. I think that's sort of one part of that. That's less on the DeFi side, but more sort of what I see on the infrastructure side on a day-to-day basis.
Just a clarifying question: are we thinking about sort of on-chain derivatives, or?
Yeah, sorry, I just meant on-chain derivatives.
On-chain.
Really, yeah. Because like I said, abysmal usage relative to what was promised.
Yeah, certainly. I think there's still a lot of just asymmetric downside with respect to smart contract risk, right? So once we have better insurance products on these sorts of products, then I think there'll be a lot more institutional participation. I mean, at Jump, we certainly participate in these on-chain markets as well, but we tend to think that we are some of the more sort of crypto-native, institutions that are playing within these markets, and to get the broader sort of cohort, there needs to be more sort of products that sort of reduce that sort of risk that these institutions might fear. So.
Cool. So we're starting to get towards the end of time. I want to leave some time for questions. So 2 more questions. First, will centralized exchanges still exist in 50 years? It's a long time horizon prediction, so it's really a binary option. And then the second question is, what is DeFi in 2100? Does the word exist anymore?
Great. You guys can use my response to the bell later. So on the first, yeah, I do think, well, so it's been really interesting to see like Coinbase's direction, really embracing sort of like native sort of Web3, technologies, focusing on the sort of self-custodial wallet, things like that. I do think that ultimately, I actually think in 50 years we'll see like central bank digital currencies and dollars or local currencies will be accessible to sort of everyday people through some sort of semi-KYC process, and that might be the onboarding mechanism for for the majority of people. I'm not sure we're going to see like huge amounts of like spot retail purchases of on-chain assets in 50 years. I think it's either going to be...
Telling me there's no GameStop in the next 50 years again? Really? There's no retail kind of like bull stupidity?
We'll see. I'll call you up in 2060 or whatever it is. But yeah, I don't foresee that being super popular. And then on the second one, DeFi. Yeah, I think DeFi will take whatever form. I think it's going to be hopefully a very research-led, very sort of exploratory space. I think some things will just fade into the background. Like I think that already Uniswap is very much like table stakes. Like it's like, oh, it's just like bonding curves, whatever concentrated liquidity. Like it's very much just a sort of taken for granted technology at this point, and I think that's great. And I want more and more things to sort of occupy that territory. And I think that whether there will be new frontiers for DeFi, on-chain derivatives, perps or whatever new mechanism, who knows? I think it's it might just be that there's no sort of feasible or reasonable thing out there, and it might just sort of not move past or expand beyond what it is today. But I think if it does, it's going to be in a very interesting area that is going to be hard to foresee now. But yeah, I think what DeFi will represent.
Come on. The fun of asking people 50 to 100-year questions is that they can only give you ridiculous answers.
Well, no, I think it's just going to be like, I think there's going to be no way to know, because like I think it's going to DeFi, if it exists, will be solving problems for people that they're going to be like having novel problems, and it's going to arise like out of a sort of market need then, which is hard to foresee now.
Still a bit of a cop out. Fine.
Sorry.
No, I agree with that answer. I think I also want to stick with my, once again, previous like 2 value propositions for like DeFi that I do believe will keep on being true, which is like reduction of intermediaries and composability. I think that ultimately those 2 things will lead to the downfall of centralized exchanges. Downfall, it sounds so tragic, but yeah, that's the 2 big ones. And
no, they're just going to the retirement.
They go to the farm. So I do think that eventually, it will mostly be DEX-led, Uniswap, and other, on-chain, derivatives.
So you're bullish on the end of centralized exchanges?
I'm bullish on decentralized exchanges, yes.
Not exactly the same.
So I think centralized exchanges serve a key and critical function, which is the fiat to crypto rail, right? And I don't know if decentralized exchanges will ever move into that sort of space, right? So that is their core and critical feature. And if you are able to interact with the user right at that sort of outset, then you kind of capture them when it comes to the later stages of whatever sort of interests that they might have, be it on the trading side or anything else. So I don't suspect centralized exchanges will die anytime soon. If anything, I probably suspect that they might grow exponentially within the next few years, particularly not on the trading side, but again, on this sort of payment rails, finance, P2P, and all of these other sort of markets that allow people from more marginalized economies to move into stronger currencies. So that's, I think, a core function that is important. On the DeFi component, yeah, it probably would echo, again, it's another cop-out, but would echo what the rest of the panel is saying. In addition to probably new sort of primitives, I would say that sports betting becomes an important core and function within DeFi that isn't super accessible. It's a massive market. It's highly fragmented, and I think DeFi is probably one of the ways in which it can kind of consolidate this unique opportunity. So yeah.
All right. When someone asks, they say, oh, like, hey, have you been to X place? And someone's like, yeah, it's in the middle of nowhere. There's nothing there. And you're like, what's the economy that keeps it up? I'm excited for someone one day to be like, yeah, this shitcoin, like that's like I guess it's an L1. What's it doing? Like, what's the economy there? And someone just goes sports betting. That's gonna be like when we made it. I will give my 50 and 100 year things. I think I'm very much in Noah's camp that I actually think nation states will be threatened by centralized exchanges and CBDCs will become the on-ramp. And I hate to say it, but it's just inevitable. I think nation states will be threatened by Binance at some point, and we'll just try to like usurp them. And I think in a 50-year time horizon, that's more reasonable. And if you ask 5-year, obviously, I don't think that. I don't see CZ building nukes to protect himself in 5 years. But yeah, I just think nation states are going to really build their own and give the middle finger to a lot of centralized exchanges.
That's what you meant by like, oh, do you believe that centralized exchanges does not mean downfall of centralized exchanges?
No, it just means that it moves to like the nation state doing it versus like the Binance is doing it. I really think the state's going to do it. There's no reason for them not to.
Would a nation state exchange not be centralized?
It is a centralized exchange, but it's different because it also controls your identity, right? Binance doesn't control your identity. You can like make many identities and use it. And I think the identity component of centralized exchange changes from the nation state to a single. And I think DeFi won't exist as a word in 100 years. It'll be like people talking about, I don't know, plumbing. Like it's like. Do you think someone will know what Kubernetes is in 10 years? Probably not. Like it'll just be like, oh, I hit like AWS.distribute and like that's it, and like it gets rebranded to something that's like simpler.
Yeah, I would second that. I think sort of right as together with my thesis about sort of the value prop here being Rails, the lower fees and the composability. I think sort of the headline I would give is DeFi has to become more boring, right, and recede into the background there. I think one thing that sort of maybe goes a little bit against what you were talking about is I'm not sure that the like on-ramping stays as a super strong concept as it fades into the background and as it merges more with the traditional rails. Like I'm not sure this sharp delineation between like fiat and crypto, as like USDC I think is already arguably blurring that line, and I think that line will continue to be blurred of just like, well, if I just send someone money, did I actually send like a token on a blockchain? Did I send something else? In the end, it's some representation of one USD, and like, why would I even care where it was as long as I get low fees?
Yeah, for sure. I think the CBDC argument is sort of that same type of thing. Yeah. I just don't see nation states being like Binance is we're fine with like Binance forever. Like it just seems like unlikely like in the long run. All right, so I want to give the audience who's been kindly sitting here through our talk a chance to ask some questions. So if you want, anything.
Hey guys, thanks for doing this. I just had a question on the derivatives comment. I think like maybe there's a specific definition that you may have been thinking of, like puts and calls and futures, but given the adoption of things like staked ETH or even USDC, if you think of that as a derivative of the dollar, like, what do you think of the idea that derivatives maybe just don't look like what we thought they would look like on chain?
Yeah, actually, this is a great question. So I feel like the second paper I ever wrote on AMMs spent a lot of time trying to talk about like what is it replicating, like what's the portfolio that being an LP in the Uniswap pool replicates, which is this like weird basket of options. It could also be represented as like these sort of kind of other types of derivatives. Like there's a bunch of different replicating portfolios, right? So in classical quant finance, you kind of take the set of like your asset universe, you look at the set of all sort of like derivative functions that you can make. Derivative function is L2 function that's square integral. And then you say like, okay, like are two things equal? And you make some equivalence relation and you quotient, and then you say like that's the space of your assets. So it's a very more technical definition of what you're looking for. So, but like that is true that like 99% of things in crypto are actually derivatives. We just chose a replicating portfolio that's very different than the one you use in traditional finance because the transaction cost structure is completely different. So like the Uniswap LP share is a really sort of dumb derivative in normal finance. You would basically, you'd be kind of having to make options and many different strikes. It'd be like really hard to do the accounting. But the number one key reason that it's a better derivative on chain is that it has an O of one trade transaction time, right? It's a constant updatable. Whereas in an order book, it's linear in the liquidity on the book, in the worst case, right? And that difference comes from the fact that you have gas fees that mutate which derivative is the most accessible derivative. And so, yeah, everything is really a derivative at some level.
Yeah, that's why it's interesting. Thanks.
If it wasn't obvious already, like we should be asking Tarun the questions. He's the real giga brain over here.
Hello.
Yeah, thanks for the panel. I want to put a question to the panelists and the moderator about the KYC question a little bit. So do you foresee innovative tooling and solution coming out to solve the KYC problem, if it is like a user experience problem, or do you think it's more of a wider policy problem, and where do you see the market going in response to that? Like, is it going to be moving away from the US, or like more kind of full-on enforcing DeFis to adapt in that sense?
I guess one thing I would say is like, there has been this trend, I'm not sure how sticky this is, but of sort of like ZK credentials for KYC. So like Espresso, I guess, is one of these things that's doing this. And like where basically you can prove your KYC without revealing much about your actual identity. And I think like something like that will be like used in the long run. I mean, you probably, yeah, strong.
Yeah, no, I mean, I think that's right. I mean, you know, in the sort of limited number of conversations I've had with like actual financial institutions that are thinking about bringing KYC on chain, it's like they're not actually solving a problem that they, like a market structure problem. They're really trying to be in compliance, right? Or in a very sort of cynical case, they're trying to, you know, have credible deniability, frankly. And so I think that they're not solving an actual need. KYC does not solve a market need. And so I'm very not interested in it from a mechanism design perspective because it's not something that is fundamental, right? It's a way to make regulators and nation states happy. You know, that being said, so you know, basically people don't really, they don't know what they want. They just want something that they just want to pass the minimum hurdle, right? So it's not really an interesting problem to think about, frankly, as an on-chain, you know, or sort of DeFi, you know, mechanism designer. Yeah, I mean, I think there's interesting things that we're going to see. I do think that sort of ZK aspect of KYC will definitely, hopefully, emerge because, you know, there's going to be people that want this, regardless of my opinions on it. And I think, yeah, there's things like the access list idea that was proposed by, I think, maybe Vitalik or someone else, you know, after the tornado ban. You know, you can prove you're not in some specific set of counterparties amongst a broader set, right? Like, there's interesting ideas there, and I think we'll see exploration along that front. But, yeah, I'll leave it there for my hot take.
Yeah, My take on this would sort of, I think, probably be a pushback on the last comment. I think sort of from Ridley, again, money laundering, if we agree that sort of there are types of money laundering that are sort of should not be the case, or at least we live in a society where there are like certain things that we don't think people should be doing, or other countries we don't want to be supporting, then if you take that as a premise, then the question is, how do you get the good parts of KYC without the bad parts? And so that's where I think the ZK comes in. Can I prove certain things about myself without revealing everything? And then I think the other thing where, and you touched on this briefly, where there's sort of interesting market design and new structures to be created, is with blurring those two worlds, the non-KYC and the KYC, right? I think what we've seen so far is just people spinning up like permission pools and saying like there's this new world, here there's KYC law, elsewhere there's no law, but thinking through, are there ways that you can have that sort of those two worlds meet in a way that still satisfies certain constraints in the real world, such as sort of non-KYC liquidity, helping drive some markets where people are KYC participants and things like that.
No worries. I think I'll just add one thing. I think that you two pretty much covered it all, but also one thing that we haven't really touched upon is the difference between KYC front ends and KYC protocols, which is not possible, right? So I think that at some point we will need to KYC some stuff, but in the end, all protocols will not ever be able to be KYC, just like how you can KYC Swift, So in the end, I don't know how it turn out, but it's kind of one of those things where the cat's out of the box, you can't put it back in.
Second law of thermodynamics. I think there was one more question. Oh, sorry.
Hi. Yeah. So my question is, just kind of going back to the KYC bit. Is there any feasible way to onboard products that do under collateralized lending to DeFi while kind of maintaining the ethos of DeFi? And if so, how do you go about that?
Yeah, I mean, from I don't know that I have a strong answer to this. I would say from first principles, as far as I've thought through it, under collateralized lending, the problem is what do you do if someone runs off with the loan and says, screw it, the collateral's worth less. It's that's the whole point of under collateralized lending. I think there you need different properties on ZK. You don't just need to know that this person, lives in some certain place and has paid taxes or whatever the normal KYC process is. The keyword here is recourse, right? You need a way to go find this person and force them to give you back the loan. And so that's actually a much more complicated set of constraints than you have in the simple case of oh, I just need to make sure this person, hasn't violated some money laundering or terrorism laws. And so I think probably we figure out the latter and then the under collateralized loans. That being said, obviously the under collateralized loans we do in TradFi, and so there are more centralized approaches here that I think we'll see in the short term.
One thing I will say is people don't realize that there is a large number of asset-backed loans that exist in the world that people think are under collateralized but aren't. And we haven't even explored all of those in DeFi yet, so I feel like those are going to get explored first. A mortgage is not an under collateralized loan, right? And there's tons of stakers in the world staking all sorts of shit, and there's going to be finance for them first before under collateralized fully works. As we saw with the Wintermute thing last week, under collateralized lenders got super rugged. It's going to keep happening.
I worked at the Fed on the repos, and the entire repo market is fully collateralized, right? That's the whole premise. So yeah, I agree with you.
I think we're gonna build out the collateralized world. It's inevitable.
Yeah, just to add on to that, I think this is kind of to the first points that we had made about the transparency of DeFi. There are a lot of collateralized loans and collateralized assets within TradFi that we just don't have too much insight on. There's a lot of asset-backed commercial paper where the actual assets that underpin that commercial paper are largely unknown. We can kind of understand that it's maybe more, an MBS, but we don't know specifically what the actual securities are and how they're structured. And so this is, again, one of the big sort of positives of DeFi that we'll, I think, continue to explore. So, second that.
I will say there is also one thing that Dan Elitzer actually talked about, wrote about superfluid collateral, which I think that in the end will improve the efficiency of collateral.
I mean, staking derivatives are.
Yeah, exactly. So I do think that over collateralized stuff is not bad, and in fact it's.
Someone can lend you the collateral and cover you, yeah, exactly, or securitize it.
Yeah, I was just going to ask, so you mentioned originally that the LP position is sort of a replicated derivative payoff, right? And I was wondering...
I know you have a very good interest in this because you just got a grant to build one of these things.
Yeah, and I definitely have an outstanding question too, and it's a problem that we're kind of tackling, that we're trying to figure out. So for a payoff that's replicated, but it's convex, there's some sort of cap on that you describe in your paper. Any ideas on how to make that dynamic?
The cap dynamic?
Yeah, exactly.
Funding rate. The dumb answer is a funding rate. You could have a funding rate that compensates for how wide the interval is moving. But yeah, we can talk about it.
All right, sounds good. Thanks.
Cool. Well, hey, thanks everyone for coming, and enjoy lunch.